Hey, listeners, welcome back to the ValueHunt podcast. And today I'm here with Kyte, the CEO of Checkit, a listed company in the UK. And so today we'll learn about their business model, what they have been doing, and what's the future outlook for Checkit. So, yeah, Kit, why don't you say a couple of words and maybe explain a bit of what Checkit does for the people that might have been coming across Checkit for the first time?
Sure. Thanks for having me on. Yes, Kyte, I'm the CEO of Checkit. I've been the CEO of Checkit for the last 4.5 years. The first CEO that we've had. My personal background is a mix of large enterprise kind of software sales at a senior level, and prior to that, military service. I was an officer in the UK military in one of the elite infantry units there. So that was my background. So it's a broad mix, but brings a bit of leadership, a bit of operational rigor, let's say, and a bit of sales. But yeah, so Checkit is listed on the AIM market, so the junior stock market in the UK. And it's an interesting story with Checkit. I'll just give a bit of background as to how Checkit appeared to be listed, and then an overview of what Checkit does. So Checkit began inside a different listed entity called Electron Technology Group, and that the primary business there was a manufacturing business called Bulgin, and Checkit was almost corporate entrepreneurship. Let's call it like this. We saw an opportunity in the market space, very different from the main business. We successfully sold the main business in Electron Technology, which was called Bulgin, to private equity back in 2019. We returned about 120 million pounds back to shareholders of cash. They were very happy with that. But Checkit remained as an independent entity at that point on the AIM listed market. Okay, so that's why Checkit remained and is still a listed vehicle. Very much still a startup at that point. If you go back, wind the clock back about 5 years, Checkit was a startup with a very, very bold vision and bold idea. And I'll describe what we do, but really over the last 5 years since I was brought in to scale this business, and also frankly to transform it and professionalize what it is we do, so we can take advantage of that opportunity. We can talk later about how we've achieved against that. So what Checkit does, Checkit is a platform that has two primary products in it, and it's specifically targeting a certain kind of use case. So it is what you'd call a digital operations platform, and it's targeting specifically those workers that sit inside large enterprises, which people might call deskless workers. Okay, so people who are working, let's imagine a Tesco's or the NHS in the UK, which is the National Health Service provider, so nurses and doctors and janitors, etc. Or you might have retail store workers, anyone who needs to move around infrastructure and do a repeatable set of tasks, drive operational delivery, oftentimes interacting with core customers. If you're thinking about food service and restaurants, the way they do their work traditionally has been very ad hoc, pen and paper, Excel spreadsheets, random tooling, and they're having to interact with a lot of physical assets, the buildings themselves, the assets that might store vaccines or bloods or anything like this, or might store the product that you're serving to customers. And it's a large operational footprint with very little visibility as to how you drive performance. The Checkit platform solves this in two ways. We have a sophisticated sensor network, so Internet of Things, telemetry reporting sensors that allows us to drive automation in the fixed assets. So all of the temperature reporting, the telemetry reporting of assets is done through our sensor network, driving lots and lots of data that feeds back into our platform. And then the other half of what we do is we equip the worker with a digital tool. This is a task management, workflow management capability, so that all of their work is done in real time. No more pen and paper, it's done digitally. They can evidence the work they've done, they can photo capture, they can barcode scan, all this kind of stuff. And it coordinates lots of people doing same tasks across many different places in real time. So then all the data is fed up into a sort of dashboard and a visualization layer. And this means that enterprise leaders, operational leaders get real-time insights into how their people and their assets are performing, and you can adjust for KPIs. And that's how you then drive what we would call predictive operations, operational excellence. Okay. And so that's kind of the genesis of what Checkit does. It's mostly a cost play for large enterprises, so driving costs out of the business. It's also a risk play, so how you minimize risk and become compliant. And at times, depending on the customer we're working with, it can impact revenue as well. Give you an example of some of the customers we have. It's all enterprise multinational organizations. So someone like BP, one of our biggest customers, we're in all of their service stations in the UK and Netherlands, Luxembourg, Australia, New Zealand, these types of places. Someone like a big supermarket retailer in the UK would be Waitrose, John Lewis. We run all their locations. We do a lot of work with the NHS. We're in the US. We have a sizable footprint there. We actually, surprisingly enough, we're actually, for a company that's still quite modest in scale, we're actually the leading monitoring provider of blood plasma storage in the US, unbelievably. US being one of the biggest global centers of blood plasma collation and then onward use for biotech and pharmaceuticals. We do the most amount of monitoring. We have 5 of the top 10 as customers in the US. So that's just to give you a flavor of what Checkit does.
Perfect. Yeah. So I think we can jump into the questions because they are related to everything you touched upon, like the recurring revenues and all that. So Checkit's annual report highlights a shift towards recurring SaaS revenue. Can you break down the current proportion of recurring revenue versus non-recurring revenue? And what is your target mix over the next few years?
Yeah, sure. So I mentioned, when I turned up to this business, we were roughly 50-50 recurring revenues, non-recurring revenues. Okay. So 4.5 years ago, we've completely transformed the target customers, the enterprises we go after, to the extent that we now have a business that's almost pure recurring revenue. So it's 94% recurring revenues as of the start of this year. So arguably we've made the full transformation now. So you're talking about a business that's, we'll be hitting around about £15 million of ARR this year, maybe a bit more, depending on sales performance, of which 94 or 95% of that is recurring. Okay. It's worth also mentioning that our contractual terms, we typically sell on a 3-year minimum commitment as well. So you've got high proportion of recurring revenues, 3-year minimum commitment. So good future visibility of income, of revenue streams coming into the business.
Nice. Actually, you've hit the question right in the nail, because my next one is on contracts and what's the average contract length and the churn rate for your core SaaS offerings.
Yes.
How have these metrics evolved over time?
Yeah, and again, it's a lot of it is about this transformation of the business, right? So when I joined, we were about four and a bit million pounds of ARR. We're now, as I say, going to be shooting north of £15 million of ARR. So we've grown. I think we've grown at a CAGR of 32-33% ARR annually over the last 4 years or so, which is reasonable. We're pretty happy with that. Always could do more. Shareholders always want more, and that's how it should be. So we aim for more, and we think that's a pretty repeatable model. 2 core metrics that really matter to this business, I think, alongside the proportion of recurring revenues is so NRR, net revenue retention. This is a business that's our average over that last 3-4 years is about 111% NRR. So what that means is that we're pretty effective at upsell, cross-sell across the existing base. So if you think about a sales cycle, what we're looking to do is land a customer, large multinational, where possible. That's our target audience. But it doesn't matter the initial size. So effectively gain a foothold in that customer and then upsell, cross-sell over time. So as I mentioned, BP, that's been a customer of ours for, I guess, coming on 6 years now, maybe a bit longer. And this is a customer in which we've actually expanded the relationship from the UK into the Netherlands, into Luxembourg, into Australia, into New Zealand, right? So we're doing more than 1,000 locations there, and they're probably 3rd largest provider of ARR to the business. So that's a good example of how the NRR machine works. The other key metric that matters to us is churn, as you mentioned. So GRR, gross revenue retention. Historically, we've actually had exceptionally low churn. I mean, not even sustainably so low. We were normally at about 99% GRR, which is a
Hmm.
quirk of it's actually a quirk of the contractual length and a few other bits and pieces.
Right.
Realistically, this is a business where we aim to be around 95, 96% GRR, which is again, it's still exceptionally high compared to other types of business. A few factors lead towards that. I think the IoT component makes the business quite sticky. When you've rolled that out at
Mm.
scale and it's doing the job that it's supposed to be doing, it becomes more risky to start to want to swap that out as long as it's delivering as needed. Yeah. So I think that helps the overall churn profile. And I think it's what actually enables the NRR thing to be so successful.
Got it. Got it. Awesome. I have here a question on the US market. With the expansion into the US market, how do the unit economics for a typical US customer compare to a UK customer, for example? And yeah, how do you expect these to change as you scale?
Yeah, so the US, I literally just got back a couple of days ago from the US, and I've spent almost the last 6 months straight out there because
Mhm.
it's a growth area within the business, right? So the US now is about 26% of the total group ARR, and that's gone from a standing start 4 years ago. Okay, so we've now established a bridgehead. It's a sustainable bridgehead. There's a organic go-to-market team, sales leadership in place, salespeople, marketing, etc., operational footprint there, and it's outgrowing the rest of the business, which is really encouraging. It's what you want to see, frankly, because it's the biggest market opportunity outside of Europe. And from a unit economics perspective, it's the margins that we're seeing on our contracts and the kind of product mix broadly similar to Europe, broadly
Mhm.
similar, albeit maybe a little higher. So US customer willingness to pay is a bit more pronounced, and sales cycles are not dramatically shorter, but they're a bit cleaner. So there's a bit more predictability and forecastability. Main reason for that, I think, is US appetite to risk, and budgetary spend. This is a common factor, right? But
Mhm.
also it's the homogeneity of the market. Okay, so
Mhm.
everyone is speaking English, and everyone has a common approach to procuring, software services and driving digital, and they're also quite adoptive of technology. When you're selling into Europe, of course, the way that the UK market buys is quite adoptive, but you might try and sell into Germany. It's a bit more of a tricky market, so
Yep.
you have more hurdles to have to jump through.
Got it. And actually, this wasn't in the questions, but just came out to my mind. Like, as the geographic mix goes more towards the US eventually, would you ever consider listing in the US or having a double listing, say?
Yeah, I mean, this is something that gets talked about at the board.
Mhm.
I mean, there's some advantages to this. It actually it's not just whether you're on the junior market in the UK. If you're on the FTSE 100, that same pressure gets applied even to the likes of BP and Shell. You
Right.
can kind of almost double your valuation compared to peers, right? And so there
Uh-huh.
is that opportunity. I think we're still, you know, of a scale that may or may not make sense when you think about listing fees and various bits. Also, I think I think some companies can come unstuck if they don't do it right. So I think it's maybe a timing question more than anything else.
Right. Right. Yeah, makes sense. Actually, I've seen companies like pursue a listing, a double listing, and then go back because the scale was small and they had to pay a lot of fees
Yeah,
and all that. So yeah, it's
yeah,
it has to be at the right size. It just
yeah.
can't be at
To
any time.
justify, yeah, there are some of these. There's like the OTC market, which we've looked at when I was in the US last year. I looked at this, and I remain to be convinced. I don't know if it's effective or not. Obviously, there are some barriers to US investors investing into European companies, and that's what you're trying to
Mhm.
bridge uh, alongside liquidity and re-ratings on the stock. But I think there's a certain scale where that makes more sense.
Right, correct. Given your current cash position and burn rate, can you provide updated guidance on break-even timing and the key milestones required to achieve it?
Yeah, so and we've actually recently announced in the last 3 or 4 weeks, actually, a quite significant cost out exercise, actually, because the business has hit a certain scale where we feel now's the time to expedite profitability. So we just made that announcement to the market. So That's £3 million of annualized cost out of the business. What that will have is the effect of bringing profitability forwards. So EBITDA profitability we would be expecting at the end of this year. So beginning of next year, we'll be posting that, and that means we're cash generative as well at the same time. So cash burn will have reduced down to effectively zero by this time next year. We're free cash flow generative as a business, whilst also building out our growth and scale at the same time.
Perfect. Okay. So the latest annual report references increased investments in product development and sales. How do you measure the ROI on these investments, and what payback? Or I know it's not always black and white with payback, but what are you targeting for new customer acquisition and all that?
Yeah. I mean, as much as I can disclose on this, I mean, from a sales go-to-market, we actually run quite a lean go-to-market engine overall when we consider certain benchmarks. So, for example, the amount of spend that goes on. So, go-to-market for us that's your organic sales, it's your sales development, it's SDR, BDR, it's marketing, it's customer success, it's commercial operations. All of that sits under the go-to-market umbrella. But that as a percentage of revenues is going to be, for this year, it'll be about 17%, which actually is pretty low. That's actually bottom quartile for companies of this size, and yet from that we're actually delivering almost upper quartile levels of growth. Certainly beyond the median. So we see that as being quite effective. It's not unreasonable to expect 2.5 to 3 million of additional ARR from that spend, give or take. You need to factor in what churn you might get in the year. And of course, given that we've got 3-year minimum contracts, that's more like, let's say you do 2.5 million of new ARR sales, that's 7.5 million of total contract revenue off, say, 2.5 million of spend. That's reasonably attractive. But it's actually the LTV to CAC ratio is better than that, because we see that our customer lifetime value average is around somewhere between 8 to 10 years. Okay, so you can then run the math through and see. We think it's pretty efficient spend for the growth that we get, but it's done organically. Okay, so that's clean. I'm not sure that we could say at the moment that if we double the spend, we'd get double the growth. I don't think quite that predictable, but I think there is an argument to say once you've got a professional go-to-market organization, which is what we've been doing for the last few years, you have a lot more confidence around within that, what is the most useful spend to put in to get additional revenue coming back through. The complement. So we haven't yet seen evidence of partnerships and alliances as being a useful addition of revenue or sales in this industry space. Yeah, but where we do see real opportunity is through bolt-on M&A for scale and either product or customer concentration, because this is an interesting fragmented market. We're arguably one of the larger companies in this space. We see quite a few organizations that are topping out around about £4 or £5 million of ARR, but just about profitable, with some quite interesting customers, a few quite large customers that we think we could do a really good job on. So actually this year we've been looking at a couple of M&A opportunities, and we'll continue to populate the pipeline. We think that's actually a cleaner way to grow. So complement an organic sales model with targeted bolt-on M&A acquisition. So that's how we're looking to do that. And then from a product perspective, that product and R&D is still the biggest cost center in the business, if I'm to be honest. When is it not for a tech business? It has been as high as 35% of revenues. We've got that more under control. It's more like 25%. By the end of this year, it'll be about 25% or lower. So look, I mean, for us, how do we judge ROI? Ultimately, it's products, and it's related to the products and the sales that come from them, and versus the cost and the effort that go into producing the innovation. We're being very targeted now on innovation. So, effectively, if there isn't a clear use case and or a customer who's actually already willing to fund it through a signed contract, we're unlikely to do discretionary spend, because this is the market that values profitability over cash burn, and cash gets it very easily burnt in a product and R&D function.
Yeah, for sure. Actually, I had a question on like when you turned profitable, the uses of cash in some of the uses I mentioned was acquisitions. And since you touched on that, I might just as well ask you right now, um, what would be your acquisition strategy? Would you try to capture synergies, or would it be like just as standalone businesses that you can incorporate in your business model? And also in terms of valuation, we all know that software and tech sometimes gets on the higher multiple side. So at what valuation or multiples would it make sense for Checkit to go and acquire these businesses? Because at the end of the day, Checkit itself like trades at a pretty low valuation, and so at some point it would make more sense to buy yourself rather than other companies, right? So yeah,
Yes.
maybe.
Yeah, yeah. I mean, look, you've got the valuation challenge. It's actually quite. It's a broader problem stroke opportunity, yeah, depending on who you are.
Mhm.
You might, if you're an investor, it's certainly an opportunity in the UK markets generally. It's a bit of a known story. It's a valuation gap. It's no surprise that we've got more and more US investors trying to get involved.
Mhm.
So that's just one thing. I imagine that as this company pivots through profitability, cash generation, you'll see a bit of a re-rating there. So that's one thing. So, the clock's ticking in that option. I think, but that of course has its own, presents its own challenges if you try and do M&A, because raising capital or, printing shares to facilitate that can be somewhat constrained by share price. I think that when you're looking, for us, when we're looking at target bolt-on M&A, it is either going to fill one of two criteria, broadly speaking. It's either going to be synergistic, so additive, accretive to the P&L. So where it's a similar product set, ultimately the one that's the most enterprise grade, which probably going to be ours, will prevail, and you'll drive the synergies through the P&L, and that's how you'll get additional scale. And hopefully there's enough of the right type of customer that we can apply our NRR kind of growth machine to that, and then that's how you spread
Mhm.
value. Okay, so that's one of the things that's quite obvious for us to chase, and by that way, the company itself will keep hitting a certain level of scale that becomes quite attractive, gives us more options down the line. The alternative, of course, for us, and we actually looked at one of these deals earlier in the year. It was public information, Crimson Tide PLC. That would have been a good example of two. So you'd have had a product fit. So we identified that it could fulfill a gap in our product set that we needn't try and build from scratch in a very similar space. And so there were clear kind of product market fit, go to market synergies there, very similar
Mhm.
customers that we're targeting. We just have more scale, so we could get the product benefits and then drive the right cost synergies from the acquisition to then really scale up that product more effectively. So that's the alternative that we'd look at.
Mm, got it. Yeah, makes sense. So going back to recurring revenues, there was a pretty strong growth. And how much of that growth was driven by net new customers versus upsell or cross sell existing clients?
Yes.
So.
Yeah. So ours is a business where, broadly speaking, 70% in any given year, 70% or more is going to come from upsell, cross sell, so NRR. Um,
Mm.
it's the way this industry works. It's why customers are sticky. It's why you've got that repeatability. I think we have to be very targeted. There was a time where we were bringing on more net new customers, but not necessarily of the right type, and then they present either a churn risk, or actually they just have a ceiling to the amount that you can grow them. So we're now much more targeted. So in a given year, what we have to zero in on is what's the best um, type of net new customer to feed into that NRR machine. So if we think we can get 15 to 20% worth of our new overall sales contribution in a year from the right kind of net new, the following year those same customers might be contributing to, let's say 10 to 20 to 30% of the NRR that was achieved in the year, right? So that's how that machine
Mhm.
is working. That's how this model works. This is not a business where in any given year you're expecting 50% of new customers to be thrown in at volume. That's just not how this business works. It's much more appropriate to drive it that way.
Mm. Got it. Perfect. So, what are the biggest operational bottlenecks or risks of scaling, especially into new geographies, and how are you addressing them?
That's a good question. Bottlenecks. I mean, I think the US and North America generally has been a good case study of how to establish a bridgehead. A lot of companies want to go there, get that international revenue coming in. Not all companies are successful, so we that
Mm,
hasn't been a problem for us. I think that this is an organization where sales cycles for these larger multinational companies can often take 12 months, 18 months if it's a seven-figure ARR customer, something like this, maybe even longer. So I think that the bottleneck there is just the investment that's required to acquire
mm,
that customer and the time duration. This is also an industry space where you're dealing with large enterprises who, more often than not, and I'd say that's 60% plus of opportunities, it's their first time bringing this kind of digital and this kind of automation into their operational footprint. So that's why the sales cycles are more extended. But it's also it can mean that they might want to break it off piecemeal, prove it in a few locations, then scale from time. So that's your main bottleneck. Is actually customers themselves understanding what they're buying and what they need to be planning for. And that's part of our job, is to educate them as to not just what the ROI is, but actually what they need to plan for over an investment in, a reasonable investment in a capability, but also if it's going to have a 10-year customer lifetime value, then actually you'll talk about a partnership that goes through, two or three different contractual cycles. So you're building a lot of goodwill. So that tends to be a thing you have to it's inertia that you're probably battling.
Okay, got it. So you mentioned like this process where some customers want to kind of test it on lower location count and then maybe scale up. How do you structure those deals? Because what if the customer doesn't want to, guess, scale up or yeah?
Well, look,
So I would like to understand that better.
typically, what's going to happen is that a customer's going to want to do some kind of pilot, some kind of proof of concept. Okay,
Hmm.
and that's what actually contributes to the 4 or 5% of non-recurring revenue we have in the business.
Hmm.
It's pilot projects that might last a month or 2 months, yeah, sometimes even a bit.
Okay, got it.
So that's a pilot, and then what we try and do is during that pilot process is then obviously deliver the full commitment sale, which then takes the business and makes it into an ARR sale. Yeah. Now, rarely does a customer say, "Look, we'll give you all of our locations at once." Let's use
Yeah.
BP as an example. The first win there was to get into nearly 400 locations in the UK, all of their service stations, all their retail footprint. That's the first win. Okay, good. This is an organization that's got 15,000 locations globally. So then you upsell Netherlands, upsell Luxembourg. Then you do a big upsell that we did a couple of years ago into Australia, New Zealand. That's another 450 locations, and then roll out, of course. So that's actually how we see these customer contracts being secured and landing. And some customers, you get that first bridgehead in, that footprint, and actually they might have an external macro event that prevents them from scaling as quickly as they would have wanted to. That's okay, but it depends what they've committed to the contract. We then will manage the kind of the invoicing, the billing accordingly, but it's normally done in partnership with the customer.
And how do you price these contracts? Because is it on a per location basis, or because it's not like say Netflix that you just pay per
Pay
account
per
or
user.
something? So
Yeah, we actually it's similar-ish. I mean, we figure out how many licenses are required, so of the workflow, and then what the IoT and the sensor footprint is based upon the
mm,
number of workplaces, right? So again, use a sort of BP as an example. You've got 400 locations, but within each location, where are the people doing work? They're doing work in the forecourt of a petrol station, doing work inside the retail store, they're doing work inside the back end where they're preparing hot goods. So those people can't be in all places at the same time. So you're actually needing, 3 licenses minimum to cover each workplace, and then you've got all the fixed assets that require telemetry, monitoring, everything else, and that's an easy thing to price for. So then the two gets bundled together as part of a recurring revenue sale. And then, of course, they've got the option to then, okay, we need more licenses, we've got more workers, more shift patterns, whatever it's going to be. You then upsell that. We have a contract that makes it easy to then upsell according to demand.
I'm guessing you don't manufacture the sensors, so the
No.
IoT devices, right? So, is there any exposure to tariffs in there, or like just maybe you could dive a bit more on that
So
particular
we've
setup?
got we own the IP, so it's our design, it's our IP. It's manufactured by a third party. Third party is near shore, so less risk on supply chain.
Hmm.
Obviously, from an inventory management perspective, we build up our inventory according to demand, but also according to fluctuations in the market. So we actually are somewhat shielded from trade tariffs. It's not an immediate impact to us. Obviously, there was a time actually during COVID, if you might remember, there was microchip shortages. Yeah, so we
Hmm.
kind of front loaded stock then to make sure we were covered, and that's seen as that kind of philosophy is seen as quite well. Obviously, sometimes can have a working capital impact, but then that just puts more pressure on sales, right, to sell. So that hasn't been we from a trade tariffs perspective, that hasn't been too bad. Also, from the US or North America, we'd already front loaded a certain amount of inventory in stock to be able to service. We've got about a year's worth of, or just over a year's worth of forecasted sales in the US already on hand. So, given the uncertainty, that's been quite prescient, I think is the word. So we haven't had too much of an impact in the business. But of course, like any business, between trade tariffs, between in the UK in particular, they've had various tax rises to do with national insurance and things like this. There are labour challenges, but we're a nimble enough business. We're just sub 200 employees, so we can weather that storm. And frankly, it's what price rises are for, with end customers.
Mhm. Perfect. Awesome. That was a great answer. Can you discuss your pipeline visibility for the next 12 to 18 months and what leading indicators you track to forecast growth? And maybe, yeah, can be useful for investors, I guess.
Yeah. I mean, again, I'm fresh off the having presented the annual results and done a roadshow with our actual existing investors, and so that's a common question. Yeah, what's the state of the pipeline? So I can say the current pipeline is at £16 million of ARR. So that's what's in the pipeline. Don't forget, we have 3-year minimum terms. So actually, from a total revenue perspective, that's nearer 50 of revenue in the pipe. What does that really mean? I mean, we have a very conservative expectation around conversions. We would expect we forecast not more than 10% conversion rate on that pipeline, even though it's a well qualified pipeline. Just historically, that's what we've seen. So you can do the maths on what 16 million at the kind of start point of the year gives you visibility on. Now, look, within that,
Hmm.
you've got a mix of some quite notable large 7-figure ARR opportunities, mid-size kind of 200-300K of ARR opportunities, and then a lot of what we call run rate business. So
Hmm.
10, 20, 30, 40, 50K of ARR that we look to sell and prosecute on. When we're doing our own budgeting forecasting in the business, everything is built off kind of run rate predictability. We include no large 7-figure deals in that forecastability, in the guidance we give to the market, in the way that we run the business. We do that because it's very lumpy and you can't quite tell the timing of when a thing will close. We also do that so that we're deliberately conservative. If one of these 7-figure deals or even a sort of late 6-figure ARR opportunity closes, then it will be material upside to the business in the year. So we would basically outperform the guidance and the expectations in the market. So that's how we run the business. That we've sort of learned that over the years, and that just means that we're not carrying risk where we don't need to carry it.
Okay, got it. In a competitive digital operations market, what specific features or integrations have proven most effective in winning deals against your top competitors?
Look, I think what makes, I mean, really the question is what makes Checkit differentiated. Yeah, and I think
Yeah.
for us, the winning, are there companies that offer some form of task management workflow software for the frontline worker? Yes. Are there companies that do types of IoT? Yes, although it depends which industry space. Which companies offer both of these products unified together? So you have a continuous feedback loop, data feedback loop between the two. Very few. So the end-to-end proposition is the bit that Checkit wins on. That's the first thing. So effectively, all of our telemetry reporting feeds into the same cloud-based platform that our task management does. So actually, a worker will get a real-time alert if a machine or an asset is failing or showing some signs of failure, so they can immediately respond to it, and vice versa, right? So that unified end-to-end piece is the segment that is a bit of a winning differentiator for Checkit. Not many providers actually have that offering, and even less are then utilizing the data, right? So think about it. The IoT is generating loads of data. Task management is generating loads of data. Who's actually building ML AI modules on that data to then be really sticky in terms of ROI? That's again something that Check is doing. So we kind of call it inch wide, mile deep. That's where we like to focus. If you think, I'll just elaborate on the industries that we play in. It's 50% of our ARR business comes from healthcare, a nice kind of high margin business area that's got lots of compliance and lots of operational challenges. That's a sticky sort of customer base. So again, I described some of those types of customer earlier. And then about 35% comes from food retail providers. So these big supermarket chains, these big food retailers, wholesale food retailers, where they've got large warehouses and operational distribution centers. This is where we tend to play. And then the remainder comes from hospitality customers, so just well-known big restaurant chains and hospitality providers. So that's pretty much exclusively where we focus. And we're quite deliberate about going deep on that and then considering what adjacent markets would complement that versus trying to solve for lots of things. So that's how we kind of win and differentiate at the moment.
Oh, perfect. So one question that I have for you is, say when you go into the new customer, not all the assets are the same for all customers, right? So some assets might require some different sensors and so on. So when you go and win a new customer, do you already have the sensors or IoT technology developed for that specific customer, or are you going to develop it specifically for him? Say it's an asset that you don't have currently in your technology stack or something.
Well, I think there's two parts to that answer. I think one is, the first one is oftentimes these customers have got hundreds, if not thousands, of locations. Each location is different, right, by definition, and therefore they've got different asset laydown, breakdown, etc. So one, they don't even know how many assets they've got. So the way we contractually solve for that is we use an average location, right? We build a contract on that, and then we either sell more or delete as it gets delivered.
Yeah.
That's easy enough. That bit's easy enough to figure out. Where they've got some unique situations, I mean, typically what you want to do is sell to the use cases where you can already cater to, not chase after a whole new use case where they've got a problem that you haven't yet solved for. But where they do raise themselves. This is an open API platform, so we also have incorporated certain third parties who have very specific capabilities in areas that may not be where we have got our own IP. That means that we can actually, more often than not, we can incorporate a use case or a different type of, say, IoT or workflow that we may not have quite easily into the system and get it going. They might even have some of their own monitoring capabilities that haven't been used effectively. We can actually plug them into our system and then give them the rest of the benefits. So that's how we typically deal with that.
Okay, got it. I'll merge two questions into one because I think they're related. So obviously, we all know that AI is the next big trend or whatever. So what are the risks of commoditization in your offerings? Like maybe someone coming in with an AI solution or a new AI model that can kind of easily build something similar. And on the other side, how can you take advantage of AI?
Yeah, it's a great. I mean, it's the most topical question. We're quite bullish actually about our space, because our space is very difficult to automate actually. This is not knowledge workers using ERP platforms, which can all be hoovered up overnight. You're talking about large operational footprints where they've perhaps never had any digital tooling in place, or if they have, it's all been a bit disparate. So actually, we see AI actually as a complement to this business in the majority rather than a risk. In fact, what Checkit's really doing, if you think about it, is generating data for the first time. So it was analog previously, pen and paper, it was just not even recorded. You had no real visibility as to how effective the operation was, predictive maintenance, asset failures, energy use, nothing. You had no insight whatsoever. We generate that data in the first place, and then we either can use our own ML modules on that data to enrich it and become more ROI additive, or with the kind of advances we're seeing in AI, we actually see that as a complement. That helps us dramatically shorten our own innovation cycle. How do we then take that AI? We don't want to be an AI company per se. How do we take the benefits of what's being created and actually plug it into the system we've already got? And so it is very much a complement rather than something that's going to overhaul this business, because at the end of the day, the kind of automation, the telemetry reporting requires these types of assets to be in place. Even for the AI to be able to work, the AI needs data to survive, to do anything with it, right? So we're the ones providing the data.
Got it. Perfect. So yeah, I have loads of questions here on profitability and capital allocation, but I'll just ask a few more questions on the business side, and maybe then we can get a bit more into who you are and your background, because I always feel like that's very interesting. So yeah, what are the key metrics or milestones you want investors to hold you accountable for over the next 12 months? And then I have another question to wrap up these questions.
Yeah, in terms of, the investors would like to hold me accountable to a lot of metrics, but I think the core ones, this year in particular, one of the core ones is EBITDA profitability. We've been very clear about that. It's accelerated. It will be achieved. So, by all means, hold me to account on that one. Also, I think top line, we've put certain top line numbers out there. So in terms of ARR growth and the total ARR numbers, I mentioned those at the start, and revenue. The ARR and revenue is so closely correlated in this business because it's 95% recurring revenue. Yeah. So those numbers need to be, I'd like to be held accountable to. Same with the NRR and the GRR, because these two metrics are these two KPIs are very important for the health of this business. So we aim to get NRR at least at 110% or above. That will be beyond top quartile for this kind of space. And GRR, we want to keep that at around 95% or better. And our historical average is like 97%, 98%, but we think 95 is the realistic number. So if those things are in place, then the focus can sit on net new acquisition. So we'd like to be held accountable there as well. Cash position is also a fundamental one. So we've got numbers in the market that give an expectation of what the cash low point will be this year before it starts building back up. Again, that's a number we're confident of at least meeting, if not beating. So again, we want to be held accountable to that too.
Perfect. Last question here on the business side. Could you tell us a bit more on your board of directors and what expertise do they bring to the business?
Sure. Obviously you've got myself, the CEO. I've got Chris Shaw, who's the CFO. He's got AIM-listed experience, was previously the CFO of a different AIM-listed business called Smart Space. They, last year, were taken private in a trade sale at I think it was a 4x ARR multiple, actually, which is seeming quite nice these days, actually. So he's got good experience of both listed and going privates, which I think are always options here. The chairman is someone called Keith Daly. He's also a 20% shareholder in the business. So actually, technically, second largest shareholder in the business, behind the largest being 21%. His experience is significant in terms of M&A. He's done. I think he likes to say he's done 30 plus M&A transactions over his tenure. So a number of these. He's also successfully done go privates as well off the listed market, returning significant cash back to shareholders. So and his is an investment banking background, so forensic focus on P&L, financial metrics, and those types of opportunity. We also have a non-exec director called Alex Curran. She is the CEO of another AIM-listed business called Aptitude Software. And so again, she brings good. They have I think more than 50% of their revenues now in the US. So for us, we're quite focused on US.
Aptitude rings a bell. Yeah, I
Yes,
think they're recently. I think Pine Tree acquired a stake in Aptitude. So yeah, interesting.
yes,
Okay.
yes, yeah, yeah.
P- Perfect. I don't know if you were done with the
Yeah,
board.
that's the board. We keep the board quite lean at the moment, actually.
Okay, okay, okay. Perfect. Yeah, very, very interesting. So I'm curious to know what kind of mistakes have you done as an executive in the past, and what did you learn from them? How did you address them? And yeah, what lessons do you took?
I mean, let's just be honest. Probably all of the mistakes that you can make, I've probably made at various points. Just be completely transparent. And what would they look like? They might look like over-promising and under-delivering. So
Yeah.
lesson number one: under-promise and over-deliver. That's been learned. That's now the aim of the game. I think probably you can work your people too hard. I think, given my background, that's sometimes an issue. Shareholders like to hear that because you're a hard driver, but actually, there comes a point where if you're working people too hard because you've overset expectations, that it was your fault for oversetting expectations.
Yeah.
Churning out good sales leaders and others because they've had too great a target in front of them doesn't really help the business. There's a cost of replacing, and there's a dent to morale when people are given
Hmm.
targets that are too unachievable. So I think they've certainly been a couple, and look, I suppose I think, and it's been brought. When I joined the business, it was during COVID, and money was cheap. People cared about growth only, and they were very losses didn't mean anything, and that's gone 180 degrees, right? So I think mentally switching from really doubling down on growth at all costs and spending accordingly to being very judicious about cash burn, capital allocation, and profitability whilst retaining growth has been an interesting journey, actually.
Mm.
But ultimately, it's the right thing to do for the business.
Yeah, exactly. Over time, like I guess it's the also the more sustainable way. The investors can switch their focus between one or the other, but over time, the one that survives, I guess, is
Yeah,
yeah.
I mean,
It's,
you got to have cash, right? Cash is king, as they say. So
Mhm.
that counts. And in this day and age, in this market, that really is the most important thing. So if you can deliver that whilst getting the right sustainable levels of growth and in a really efficient business, I think that's ultimately much more attractive these days. And that's the journey that Checkit has delivered and is now going to kind of grow out of. So that's quite fun.
Perfect. Nice. I would really like to ask you, where do you see yourself in 10 years' time? Because unlike some other CEOs, that no disrespect to them, but they're already quite old, so maybe in 10 years they'll be retired. You're
Yeah,
pretty young. So yeah, maybe you have a different view on this question.
it's a good question. Yeah, I don't think I'll be retired in 10 years, but if I have, then two things have happened. I've either done really well or I've just given up. And I think
Yeah.
that the latter is unlikely. It's not in my DNA. But I would like to think that Checkit's got a decent runway ahead of it in terms of growth. As to what that growth looks like and whether we remain listed or we consider an exit opportunity at some point off the markets to fuel that growth, that might well be the case. Personally speaking, I actually quite enjoy the pressures of being a CEO and building and growing businesses. I would imagine there's a couple of turns of the handle yet for me. I appreciate. I'm not quite as young as I look, actually, but I've certainly got many more miles under the hood to go. So I would imagine there's a few more turns of the handle there, and we may at some point go beyond Checkit if the opportunity and the conditions are right, and keep growing that way. So that's probably what the future looks like. But look, I'm quite entrepreneurial minded, so I think the world changes very, very quickly these days. So frankly, I just don't have a 10-year view. I do know that I enjoy what I do, and I'd like to be in the game as long as I can, whilst I'm having fun and getting reward from it. But let's see how the world looks. 10 years is going to look very different from today, I think.
Mm. Yeah, that's for sure. Uh, Actually, I would like to ask you on how does it feel to be a public company CEO? Because I, from my previous conversations with the public company CEOs, and I've only interviewed public company CEOs, there's a lot of mixed opinions, right? Some of them like it, some of them hate it. So yeah, where do you feel?
I mean, look, I think if you'd asked me about a week and a half ago when I just finished the annual results and I'd done the investor roadshows, I would have said, it's a 50-50 job. This, there's
Mm.
people like to throw rocks from the sidelines, yeah.
Mm-hmm.
But the flip side of that coin is that there is I guess there's a certain, I don't know quite know how it works anymore, but there's a certain prestige or status or value that comes from being a public listed company. You're held transparently and naked to the market,
Mm-hmm.
and there is no smoke and mirrors. There is just what there is, and you can get, as I say, mark to market on a sort of hourly basis if you
Mm-hmm.
want to. I think that that's quite good. It actually provides a level of focus and rigor and clarity into the business that is necessary at times, although sometimes it might be a bit too short termist. So personally, like I've been doing this with Checkit for about 4 years or so, and I've learned a lot. I quite enjoy it overall. It's a bit of a roller coaster. I think when times are good, if you speak to me, I'd say it's the best thing ever. When times are harder, I'd say to you, everyone's feeling the pressure, and it's not just us; it's fund managers. It's everyone's getting some pain, and it's less fun. But overall, I think it's been a great experience. I wouldn't rule it out in the future. Put it like that. So it's not like you do come across some CEOs who are like, okay, I'm going to go to a PE-owned portfolio company. I'm never going back to the public markets. And
Mm-hmm.
I can understand them 100%. I absolutely can. But personally, I wouldn't rule out being a listed company CEO in a different organization down the line if that made sense. It's a good experience to
Mm. Got it. This wasn't also in the questions, but I'm just curious. What have you learned from interacting with investors, if anything? And yeah, just like, have you been able to build like relationships, because sometimes it can be a bit transactional, right? So just curious on that side.
Yeah, look, I think our investors are a mixture of institutions, fund managers, and high net worth individuals, private investors, retail investors. These things. I think relationships are really key, and trying to get the biggest challenge is trying to articulate what's happening inside the business versus what their expectations might be. So, investors might sit across a number of different investments in different companies, and they get the benefit of seeing lots of different types of company, some oftentimes experiencing similar types of problem, right? And so they can
Mm.
zero right in on the key questions to ask. I think that the biggest challenge is articulating what's unique about this business, this industry, so that their
Mm.
expectations are managed accordingly. Where I've seen problems is when an investor's expectations are not aligned with the reality of what the business is capable of, and then they might get either upset or they might be focusing on the wrong things. And I think it's really
Mm.
important to manage that, and that can only be done by cultivating relationships. So I think they can sometimes be transactional, but the relationship and the narrative and the expectation alignment is really key. And if you get that right, then they can be quite supportive, right? You can certainly, and the easiest way they can be supportive is if you need to raise capital or
Mm.
get votes on an M&A deal or something like this. And so that's why you need to cultivate these relationships so they can understand what it is you're trying to do.
Perfect. Awesome. So what do you fear?
What do I fear?
Yeah,
What, in my personal life or in the business world?
I don't know, first thing that comes to mind. That's why I ask it like very straight to the point.
What do I fear? Not a huge amount, I have to be honest with you. I'd be absolutely honest with you, I've been in combat situations in Afghanistan, Iraq, so my fear threshold is quite high. I've got to be honest with you. If a shareholder wants to get worked up and start shouting at me and then my CFO and the team, and that's okay. I can take those kind of bullets. Yeah. No, but the biggest fear I would have is probably the pressure I put on myself to deliver beyond what we say we're going to do. So it's this
Mm.
kind of perfectionist quality. And so fear of failure is probably the single greatest fear I would have personally. And that's entirely self-driven. I, I'd like to think I do a pretty good job, but if people say it's not good enough, then then I'll put more pressure on myself to do better. So I think that's pretty fair.
Hmm. Got it. Awesome. So what kind of motivates you when you jump out of the bed and say like, okay, new day? What drives you?
I think it's the cut and thrust of it's the cut and thrust. The great thing about a job like this and a business like this, there's never been one week that's been the same as the previous. One
Hmm.
week we might have, a key customer pursuit that's nearing its culmination point, and we're going to get a big deal, not get a big deal. We might have some product challenges. We might have a customer that's experiencing. Last year, and this is quite a topical issue. Last year, we had a customer in the US that had a major cyber attack. Their entire business was taken hostage by Russian cyber hackers, actually. And what it all came down to was whether our product was still recording all of the data that's necessary across 300 locations in the US, such that they wouldn't have to throw away all of their inventory, which would have been in the millions of pounds worth of loss. And so it was a very nervous situation because actually even our product was technically taken hostage. And it
Yeah.
was only as the team was able to bring it back online that we were able to prove categorically that 100% of their locations were secure and all of their products and inventory was secure. If you think about that, that's a crazy situation. Like this, whilst we're a provider of the services business, the fact that their entire business was contingent, well, not their entire, but frankly, the livelihood of that company's CEO and CFO and everyone else was contingent on how bad is this mess. And if the answer was it's
Hmm.
all protected, they were very, very happy with us. They took me for lunch and all this kind of stuff. And thank you. So you get this kind of stuff in a week, which is quite cool, right? And so that, for me, that's what motivates me. You wake up, on a Monday morning is always my sort of more nervous time because I'm like, what is this week going to deliver for me? Because there's always an ambush. There's one ambush
Yeah.
left, one ambush right. It doesn't matter. There's always one. And I think it's how you respond to ambushes and making a team that is able to respond to ambushes that I think sets us up in good order.
Mm, nice. So, what do you enjoy doing outside of work? Like
Yeah.
besides being a perfectionist and over delivering.
Well, I mean, I'm not. I wish I could over deliver as much as I wanted to. Yeah, I think again, I mostly under deliver according to what I'm hoping to do. Look, what do I love doing? I love being in nature. I love. I used to do lots of different kinds of sport, and I'll do triathlons or I'll do lots of trail running these days up in the hills and the mountains. Get into nature, just hiking and that kind of stuff. I love that. It's a good way to cleanse the mind. Get a bit of perspective. I do like to travel actually to some quite adventurous locations, let's just say, mountaineering in northern Iraq, for example. Not many people climb the highest mountain in Iraq. I have done that. So, yeah, and that's my spare time, right? So you can make of that what you want. But so those things are just interesting because it gives a bit of color to life.
Nice. Yeah. Perfect. Okay. So last question before we wrap up and say goodbye. How often do you check the company's stock price?
Yeah, again, that really depends on the day and the week. You know what? I check it a lot less than I used to because I came to the realization that it's somewhat meaningless at a certain point in time. It's the trend that matters. And I think actually what's more important is that the operational performance of the business is heading in the right direction. Because if that's the case, then at some point you always get a pickup and a re-rating in the share price, right? So
Mhm.
it's much easier to manage a share price up with your operational performance being where it needs to be than the other way around and chasing the share price. That's not a good place to be, right?
Yeah, exactly. I really see way too many CEOs trying to kind of over communicate with the market when their business isn't doing that well. So I would say like first thing first, right? So please first get the business profitable and growing and whatever, and then you can share your story and be proud of it. So
Yes,
yeah, it's very interesting.
yes.
So yeah, just wanted to thank you for committing this hour to myself and my viewers, and you have an open invitation to come back whenever you want to share anything, any updates or something like that. So yeah, thank
That's
you so much.
great. It's been a pleasure. It's been a pleasure. Thanks so much for having me on.